So, you've mastered stock investing, right? Just kidding. Most of us are still figuring out index funds, and now everyone's talking about private equity like it's the secret to quick wealth. But what actually is it? And can regular people invest without needing a yacht and a $10 million portfolio? Anyway, let's break down 15 must-know facts about private equity investing for beginners. Number 15. What even is private equity? At its core, private equity is a form of investment where funds are used to acquire ownership stakes in companies not listed in the stock exchange. You're buying into private businesses, not Apple, not Amazon. Think fast-growing startups, struggling businesses ripe for a turnaround, or even mom-and-pop companies with big potential. It's kind of like Shark Tank, but without the camera crew. You're looking for the next unpolished gem, buried deep beneath 10 PowerPoint slides and a dream. Number 14. It's not just for billionaires anymore. Private equity used to be exclusive. Think Wall Street bros with 7-figure minimums. But not anymore. This shift is driven by regulatory changes and fintech platforms breaking down traditional gatekeeping. It's still not friction-free, but it means motivated retail investors now have a shot at private equity. 13. There are different flavors of private equity. It's not one size fits all. You've got buyouts, which involve taking control of a company to restructure it, growth equity, which involves investing in fast-scaling businesses, venture capital, which essentially is betting on startups, distressed investing, which is buying struggling companies at bargain prices. Each one has a different risk profile and a different oh crap potential. Buying into a distressed company is basically saying, I think this dumpster fire still has some potential. And venture capital, that's just legally gambling with a tuxedo on. Number 12. Returns can beat the stock market, but it's not guaranteed. Over the last few decades, private equity has outperformed public markets, sometimes massively. But here's the catch. Past performances does not guarantee future returns. And unlike stocks, you can't just sell when you're bored or nervous. If you're expecting daily excitement, you're in the wrong kitchen. Also, keep in mind that the impressive returns you hear about often come from the best performing funds. Many underperformers or failed funds aren't included in those stats, a phenomenon called survivorship bias. Number 11. You're locking up your money for years. Most investments come with a 3 to 7 year holding period. If you're used to day trading or checking your portfolio every hour, this will feel like watching paint dry on a locked vault. It's not investing for people who panic when Bitcoin drops 20%. This is bury it in the backyard and forget it exists type of patience. You'll forget that you even invested, until one day, years later, an email shows up titled Exit Event. Or worse, no email at all, just a closed website and a broken dream. Liquidity can serve you by removing the temptation to time the market, but it also means you need other parts of your portfolio to stay flexible. Number 10. Accredited investor rules still apply to most deals. To access many high-return opportunities, you need to be an accredited investor, meaning you earn over $200,000 a year, or have a net worth of over $1 million, excluding your home. New platforms are pushing for regulatory reform to open more options to informed retail investors. In translation, private equity still thinks you're not rich enough to lose money with them. But the good news, the rules are slowly changing. So even us peasants may soon be allowed to risk it all like the pros. Number 9. There are semi-private options for regular people. The rise of REIT-like private equity platforms lets non-accredited investors in. These options often offer more liquidity than traditional PE, with quarterly redemption windows and automated reporting. They're ideal for learning the ropes while still getting exposure to non-public assets. Number 8. You're betting on the team, not just the idea. In public markets, you bet on performance. But in private equity, you bet on execution. That means, who's running the company? Are they smart? Are they experienced? Or are they just good at raising hype on LinkedIn? A great idea in the wrong hands becomes a TED Talk, not a business. If you wouldn't trust them to run a lemonade stand, maybe don't hand them $50,000. Number 7. It's illiquid. But that's the point. The lack of liquidity actually protects you from panic selling during market dips. Private equity investors can't make emotional decisions because they're locked in. It's forced discipline. Basically, financial adulting. No drunk trades, no sell it all button, just quiet suffering or victory years later. Number 6. Due diligence is not optional. Private companies don't have the same disclosure rules as public ones. That means it's your job to research things, otherwise you're just throwing darts in a dark room and hoping that there's even a dartboard. And hey, if this has been helpful so far, make sure to hit that subscribe button. We break down trending money topics just like this every single week. Number 5. Private equity funds take big fees. Now, this isn't Vanguard with its cute little 0.05% expense ratio. Private equity firms often charge a 2% management fee plus 20% of profits. Yeah, they make money whether you do or not. It's kind of like hiring a personal trainer who gets paid even if you gain weight. These fees are the country club dues of investing. And yes, you're paying for the privilege. Number 4. Most investors don't get in through funds. They get in through deals. Most beginners enter via real estate syndications, startup crowdfunding programs, or direct small business investments. Smaller, direct entry deals often offer more transparency and flexibility, but they also come with higher risk and less institutional support. Number 3. You need patience and a backup plan. Don't put your rent money or emergency fund in a private equity deal. This is long-term capital. If things go well, you could triple your investment. If not, you could be stuck holding shares in a company that went from disruptive to bankrupt in 18 months. It is not for the faint of heart or the undercapitalized. Your private equity investment should never compromise your core financial stability. Number 2. You're chasing equity, not just cash flow. Unlike rental property or dividend stocks, private equity doesn't always pay out along the way. Most returns come at the exit, when the company sells or goes public. So if you're in this game, you better be okay with delayed gratification. There's no monthly income, just the faint hope of a giant wire transfer 6 years from now. Your payoff is tied to the company's growth and eventual sale, not its short-term revenue. That makes your exit strategy, an initial public offering, merger, or buyout, the single biggest driver of whether this was a great investment or a cautionary tale. Number 1. This is how the wealthy get wealthier. Here's the real reason private equity matters. It's how rich people stay rich and get richer. It offers asymmetric returns, insider access, and less volatility than the public market. And that doesn't mean it's for everyone, but if you learn how to navigate it smartly, you're no longer just playing the financial game. Have you ever looked into private equity or real estate syndications? Or does the long holding periods and high barriers still keep you out? Drop your thoughts down in the comments below and tell us if this is something you'd ever try. But that's gonna wrap up the video for today. If you found this helpful, be sure to hit that like button, subscribe for more smart moves that actually build wealth, and share this with someone who's still trying to hustle their way to freedom. They need to hear it.